Let's have a look at this question now. It says that during the year, Sigma Limited acquired a 30% shareholding of Omega Limited for a consideration of 5 lakh rupees. Sigma Limited has concluded that it has significant influence and hence Omega Limited is classified as an associate. Below mentioned are the details of the net assets of Omega Limited on the date of acquisition. The book value is 10 lakh rupees and the fair value of the net assets is given as 12 lakh rupees. The above difference of 2 lakh represents the higher fair value of machinery as compared to the book value. The remaining useful life of the machinery is 10 years. Post-acquisition, Omega Limited has earned a profit of 2 lakh rupees, out of which it has distributed a dividend of 18,000 rupees. In addition to this, Omega Limited has recognized a fair value loss of 40,000 in the other comprehensive income. The question says, calculate the carrying value of the investment in Omega Limited at the year end using equity method. Now, what you would like to remember here is that, yes, there is an original cost or the cost of investment given, right? Now that comprises of the goodwill aspect, right? As we have learned that for an investment in an associate, the goodwill is not separately recognized. It is a part of the cost of the investment itself, okay? With a 30% share, we can simply argue whatever is your cost of the investment, right? Take the share of profits, reduce any dividend, or let's say any losses, the share of those losses which are arising through the other comprehensive income, right? That's a very straightforward calculation that we can do to arrive at, of course, the carrying value of the investment in the given case. However, when you look at this difference of 2 lakh rupees, right? Effectively, you acquired a stake in, let's say, Omega Limited, and the fair value of the business was more than the book value. So that difference also would be charged, and the share of the depreciation, right, will also be impacted through your financial statements. The concept is exactly the same as we have done in case of consolidated financial statements. There is no difference between the two, right? It is just that you're looking at our respective share of the change. Okay, so how do we go about it? We say the carrying value of investment in Omega Limited, okay, that would be cost, which is 5 lakh rupees, plus share of profits. So the company made a profit of 2 lakh. So 30% pertains to you. So this becomes 60,000 minus you recovered your investments in form of dividend. So 30% of 18,000, which is 5,400, is your recovery of that investment minus share of OCI loss. Now this is given at 40,000. We take 30% of that, which becomes 12,000 for us. Now, when you look at this fair value difference, right? So this fair value difference, for example, would be 2 lakh rupees, but the life of the machine is 10 years. For the particular year, we would want to say the share of depreciation, which is 2 lakh divided by 10, and 30% pertains to you. That makes it, of course, 6,000, right? So even that adjustment is required to be made when we look at, of course, the investment made in an associate. Okay, so when I look at the total now, it says 5,60,000 minus 18 makes it 5,42,000 minus 5 would be 537. So that becomes 536,600. So your carrying value of the investment at the end of the year, right, would be, let's say, 5,36,600 in the given case. All right. Let's have a look at the formal solution. This is something that we have done already, and that's how you start looking at, of course, assessing it. You've got the investment value 5 lakh rupees, the share of profits minus the dividend, minus the share of losses, and of course, the share of, let's say, the depreciation on that particular machine, which of course results into the carrying value, including goodwill. We don't have to really mention that because the goodwill is considered to be a part of the cost of the investment itself. All right. Now, very specifically, we dealt with the accounting part of it. Just like the group accounting, there are some exceptions or exemptions from the equity accounting in case the entity, let's say, is, for example, let's say a wholly owned or a partially owned subsidiary, and the other shareholders do not really worry about it, do not object, and the entity is, for example, not traded on a public market, it's private company, and it's not in the process of, or has not filing, any financial statement with the recognized stock exchange, right? So in that context, you don't have to worry about that any investments in associates of that entity, right? That may not be, let's say, required in this particular case. That is something which is, the exception which comes into the picture, right? The whole idea is that it could be costlier, right, to do these accounting. So if the shareholders in general agree, you don't have to do these things. And of course, in that case, the accounting will be done either at cost or as per Ind AS 109, where we look at, of course, the fair value measurement, either through OCI or FVTPL. Very likely it would fall in the FVOCI category in that case, right? In case an associate is classified as held for sale, just like a discontinued operation, right? Just like a discontinued operation, it will be accounted as such, okay? It needs to be observed whether, it's a disposal group if it's too small an entity, right? But usually it would be falling within the definition or the scoping of, let's say, a discontinued operation. So need to be carefully assessing that part also. Okay. Of course, in case the significant influence of joint control ceases to exist, then the equity method shall discontinue. Okay. Now, this is the final leg of our discussion. What we are saying is that you have made an investment in an associate. Okay. What if your investment gets impaired? Now, why would they get impaired? Because probably the value of that other business has gone considerably down. Okay. Maybe that business is doing, really poor. There are financial difficulties, right? There could be some legal repercussions that the entity is facing, right? So you need to assess those, right? You need to have a very clear demonstrated evidences which suggest that there is an impairment of the investment that you have made in that associate, right? So there are instances we look at significant financial difficulty, to that particular associate or joint venture, a breach of contract, for example, let's say a default, etc. The entity, for economic or legal reasons, is in a financial difficulty, is granting an associate or a joint venture a concession which is not otherwise, doable, or it is likely or is probable that would get into that particular investment, will get into bankruptcy or a financial reorganization. There could be multiple reasons for these. I mean, there could be another partner with who you are working with under a joint venture arrangement, and that partner has gone bad. You on your own do not want to continue. Okay. Economic factors or social factors, could be multiple things for that reason. COVID could be a large reason wherein many such investments would collapse. So you look at all these objective evidences to substantiate that there exists an impairment, right? What if the impairment happens? How do we deal with that? It's a very straightforward accounting. We would simply say an impairment loss. And of course, the investment would be reduced to the extent of that particular impairment. Okay. And that's what it is. Anything which is impaired, of course, you would be accounting that as let's say, as per the provisions of Ind AS 36, which is impairment of assets, right? So that is where you start looking at this context. The only thing that you want to remember, since the goodwill is not recognized separately, you don't have to test that for impairment purposes. The entire value, for that matter, the entire investment, including the goodwill, is tested for impairment as a single asset. And of course, the parameters of carrying value versus recoverable amount, and recoverable amount is of course higher of the two, the value in use and of course fair value less cost to sell. So you compare those and apply the concepts of Ind AS 36 in that case, right? What is critical to assess in determining the value in use, right? You need to assess what's your share of the present value of the cash flows which are expected to be received, or the present value of those dividends, for example, which are expected to be received, and eventually the ultimate disposal also. You start bringing all these practical concepts when you look at, of course, the impairment losses assessment, right? There are instances now where we look at, of course, why probably, or what could be a trigger of, let's say, an impairment. It says that ABC Limited has an investment in Z Limited, which is classified as an associate. The shares of Z Limited were listed on a recognized stock exchange. Z Limited is delisted and shares are no more publicly traded. The delisting is on a standalone basis, cannot be considered. So it could be a case wherein, it could be, let's say, the SEBI, for example, may simply, look at delisting that share because of some reasons, right? There could be a issue with respect to the documentation. There could be an issue with respect to the the filing of, let's say, forms and the relevant information. So SEBI can very well penalize. So the delisting itself may not be the criteria, let's say, to assess whether there is an impairment, right? Likewise, a credit rating decline or impact is in downgrade may suggest, but it's not in itself a sufficient evidence, right? To say that there's an impairment, right? So you need to be looking at that as well. I think you would want to certainly pick it up on this front, that if there is a significant change with an adverse effect in the market within which that investment in the associate or the joint venture operates, in those contexts, very likely, okay, you may want to assess that this suggests an impairment loss. So one needs to be looking at this thing more carefully. And I think the messaging is that at large, right, a delisting or a downgrade in the credit rating may not be the sole evidence for, let's say, you to assess an impairment loss just like that, right? So broadly, that's something which is what we covered around this concept of Ind AS 28, which is investment in associates and of course joint ventures. You again want to recollect that we don't consolidate everything. We only consolidate the equity element, right? And accordingly, your URPs, etc., are taken to the extent of your share, okay? And the accounting works like that, right? Again, the final call on this, where you look at, you may be required to assess under a particular scenario whether it meets the criteria of an investment in associate or not. So you need to remember those parameters, whether there exists significant influence. You look at those indicators which may suggest that, let's say, that there's a significant influence available, the presence on the board, impact on the financial decisions or strategic decisions, your influence on the operational and financing decisions for that matter. You look at all these parameters, right, when you try to assess whether there exists a significant influence in practice or not. All right. Thank you very much.